Hello traders, this is Mega FX, and in today's video I'll be talking about inversion fair value gap for trade entry. I'll be talking about how you can use inversion fair value gap for trade entry. Inversion fair value gap is one of the most powerful entry method you can adopt in your trading career. It's one of the entry criteria you need to use. We have different types of entry models, fair value gap, break and support and resistance, order block, many. But inversion fair value gap is one of the most powerful entry model you can use. Then, if you must use inversion fair value gap for trade entry, there are some certain rules you must take into consideration. And the first one is market must seek some sort of liquidity. Market must sweep some sort of liquidity before you looking for inversion fair value gap to form. What do I mean by that? If, for example, market is coming down to this support, for example, and we are having something like this, lower low, lower high, lower low, and on getting to this place, market takes liquidity below here and still move up immediately. So this is what we mean by sweeping of liquidity. Market must take some sort of liquidity. That is the first rule. Then the second rule, let me remove this one. The second rule is that the candle or candles that sweeps liquidity must have one significant FVG. It must have one singular fair value gap. This is what I mean. This is the leg. This is the move that sweeps liquidity. Then this move, we must have one singular fair value gap that price created on this leg before taking this liquidity. So this is what I mean. Anywhere around here, price must create one singular fair value gap within this range. So if we see it like this, then for this particular move to become inversion FVG, because this is now fair value gap FVG, so we need the inversion fair value gap for trade entry. So we will need another move. As we have aggressive move to the downside taking liquidity, we also need a fast close up like this above the fair value gap. We must get a candle closure above the fair value gap. Then we will now be looking for a retest of the fair value gap to continue the trade to the upside. Then what this does is that market, by creating this fair value gap, market induce some traders to keep going short because of the fair value gap. Some traders we take sell entry on this fair value gap and continue to take the market down. But what will happen? Market will take them out because it was never a break of structure. It was never a valid break of structure to the downside, but a liquidity grab or liquidity sweep. So we need to have a candle closure above the fair value gap. Candle closure, it must not be weak. We must get a candle closure before we consider it an inverse or inversion fair value gap. Let me go to my chart and show you some examples. How I use inversion fair value gap for trade entry. This is on USDT. This is crypto. So Let me delete these rules. Okay, this is on 1 hour's time frame. If you notice what market was doing here, market was coming down, going up, coming down, and at this point, look at what I'm showing you. If you look at this low, market swept this particular low. Then when the leg that swept this low, or the candles that swept this low, we have one singular fair value gap. Look at it here. And what happened? When market swept here, created this fair value gap, you notice that another candle also came back aggressively, closing above this fair value gap. Look at it, closing above this fair value gap entirely. This is the first one. We had our our liquidity sweep here, where price ran through this low, then creating a fair value gap for us here, and later closing above the fair value gap. Then if you notice what happened here, you notice that market came back, tapped into the fair value gap, now becoming inversion fair value gap. Because immediately we have this particular move to the upside, this fair value gap is now a failed fair value gap. That is what we call inversion fair value gap. The failed fair value gap is known as inverse fair value gap or inversion fair value gap. Same way we have a failed order block, which is a breaker block. You understand? So you instead of you to be crying that this fair value gap did not work again, you need to look for entry, a retest of the fair value gap. So this would have been your entry at the tip. Then put your stop loss below the manipulation. Then you can target any available highs, the next drawn on liquidity. Understand? This is the first example. Let me show you another example. Still on CUSDT. I'll show you another example. Look, if you look closely, you notice that here we have fair value gap here. We have fair value gap here. If you can look, I use CUSDT in conjunction with CUBTC because they are both positively correlated. If I show you the second pair, which is CUBTC, you notice that here we had SMT divergence. If you know about SMT divergence, here was an SMT divergence tapping into the fair value gap. So fair value gap now is our draw on liquidity. So market came right, tapped into the fair value gap, taking liquidity below this low before the fair value gap. Then if you look closely, you notice that these full legs, these full candles, consecutive candles that took liquidity below this low, we had one singular fair value gap here. Look at it here, singular FVG here, before when the market was trading down. Then if I drag it to the right hand side, you notice that after we swept liquidity, tapped into the fair value gap, you notice that price came back aggressively, closing above this former fair value gap, giving us inversion fair value gap. But now market did not come back retest. So in some cases, if I see aggressive move like this, I will, if it is not, if the candle does not close way very far away from the inversion fair value gap, I will take the entry immediately that candle closes, or I will go down to 15 minutes time frame. I can go down to 15-minute time frame or 5 minutes time frame and look at where 15 minutes candle closed. Look at where 15 minutes candle closed above the fair value gap. So I can take my entry here at the close of this 15 minutes candle, then put my stop loss below here. Look at it. Then I target anywhere I want to target, 1 to 2, 1 to 3. You understand? If you see go to 5 minutes time frame, you see 5 minutes close. But I like using 15 minutes time frame because 15 minutes time frame is a bit powerful than 5 minutes time frame. Because why I do this is that you notice that in some cases market will be so aggressive. Market will not give you that retest you are waiting for. So after you've marked your inversion fair value gap, your fair value gap and waiting for disrespect of the fair value gap, you can go to 15 minutes time frame and wait for 15 minutes closure. On the 15 minutes closure above the fair value gap, making it inverse fair value gap, you can take your trade. You know, I think I have another example as well. Let me check whether I still have another example here. Another example here. I don't think so. I don't think I have another example here. Maybe if I go to another pair, but I don't want this video to be so long. So I want you to go to your chart and practice. You go to your chart and practice. Check as many places as possible where you will see this inversion fair value gap, then apply it to your entry strategy, entry model. You see that it's very, very powerful when you apply it correctly. If you find this video helpful, don't forget to like, share, and subscribe, and turn on the bell notification so that anytime I drop videos on my channel, you'll be notified. Thank you.